Most people think banks exist to help entrepreneurs. They don't. Banks exist to manage risk. And if you walk in with $400 and a dream, you'll discover that in less than 5 minutes. Daniel Reyes certainly did. Daniel felt it on a Tuesday morning in Austin, Texas. He was 26 years old, carrying a manila folder with a business plan for a logistics software company and $400 in his checking account. He'd rehearsed his pitch in the car. He walked up to the loan officer's desk with his shoulders back, trying to look like a founder instead of a kid who hadn't slept properly in 3 weeks. The loan officer didn't even ask him to sit down. She glanced at his account balance on the screen, glanced at him, and said the bank couldn't extend any credit without collateral. Daniel didn't have collateral. He had an idea, a laptop with a cracked screen, and a stubbornness that his mother used to call dangerous. He left that branch and sat in his car in the parking lot for 11 minutes before he could drive home. But what Daniel didn't know that morning was this. One day, the same industry that rejected him would compete for his business. He just had no idea how much would have to change first. That's the part nobody talks about. Not the rejection itself, but what it does to you. It tells you quietly that you don't belong in that building, that the glass doors and the marble floors were built for someone else. Daniel didn't have a wealthy family. He didn't have a Stanford degree or a cousin at Goldman Sachs. What he had was a used car, a folding table he used as a desk, and a habit of listening to Alex Hormozi videos on repeat while he cold called potential clients from a spreadsheet of 600 names. Somewhere around call 400, a small trucking company in Chicago said yes, not because his product was perfect, because he showed up at 6 a.m. to fix a bug himself, in person, in the freezing cold, without charging them a dime. That one client became 3. 3 became 11. And by the time Daniel turned 28, his software was processing freight routes for companies across 4 states, and his business account held its first real balance, $140,000. But that wasn't the biggest surprise waiting for him. He remembers walking back into a bank, a different one this time, in Miami, where he'd relocated to be closer to a logistics hub, and something had shifted. Not everything, but something. The teller was polite, not warm, but polite. He got a business checking account with no questions asked. Nobody offered him coffee. Nobody called him by his first name. But nobody made him feel small either. He was, for the first time, invisible in a way that felt like relief. That's the strange truth about money and dignity. At 0, you're visible in the worst way, visible as a risk, a line item, a name on a rejected form. At 100,000, you disappear into the background. You become just another customer. And somehow, that disappearing act feels like progress. Daniel kept building. He hired his first employee, then his 5th, then his 20th. He made mistakes that kept him up at night. He once signed a vendor contract without reading the cancellation clause, and it cost him nearly $60,000 in penalties before a lawyer friend in Denver helped him untangle it. He learned the hard way that being good at building something and being good at protecting it are 2 completely different skills. And this is where the story takes an unexpected turn. By the time his company crossed $2 million in annual revenue, something happened that Daniel still describes as surreal. A private banker called him. Not the other way around. She introduced herself and explained that based on his growing business activity and account balances, he'd become eligible for the bank's private banking division. Daniel almost laughed. 2 years earlier, a woman behind a desk wouldn't give him a business checking account without a hard credit pull. Now someone in a blazer was calling him on a Tuesday afternoon, using his first name, asking about his long-term goals. He took the meeting. Daniel later discovered something most people never realize. Many large banks have dedicated private banking divisions designed for clients who maintain substantial assets or complex financial needs. The exact requirements vary by institution, but qualifying often depends on investable assets, business relationships, or both, not simply income. His banker wasn't there to judge whether he deserved trust. The math had already done that. Banks don't sell money. They sell confidence. And confidence in banking is built with numbers, not promises. That's when Daniel understood something most people never get the chance to see from the inside. Banks generally assess customers based on measurable financial risk and the depth of their relationship, not simply on personality. Daniel was the same relentless, slightly reckless, deeply stubborn person he'd been in that Austin parking lot. What changed was the number next to his name, and somewhere along that number's climb, he crossed thresholds most people never even know exist. But here's what almost nobody realizes. People often think banks reward confidence. They don't. Banks reward predictability, predictable cash flow, predictable assets, predictable repayment. Daniel hadn't become more confident between that Tuesday in Austin and this Tuesday in Miami. He'd become predictable. And predictability, it turns out, is worth more to a bank than charisma ever will be. By 34, Daniel's company was valued north of $50 million. The irony wasn't lost on him. The same system that once saw him as too risky now treated him like someone too valuable to lose. There were no lines anymore, no forms to fill out an account. Because of his long-standing relationship and strong financial profile, his banker could move faster than any process available to him years earlier. Wire transfers handled personally, sometimes on a weekend, a 7-figure bridge loan for acquiring a smaller competitor moving through underwriting, in days instead of months. Because the relationship and documentation were already built on years of trust, not a folder handed across a counter for the first time. He was invited to closed-door investor dinners where people talked about tax strategy the way normal people talk about weather. He met a woman there once who reminded him of Sarah Blakely. Self-made, quietly sharp, uninterested in performing wealth, just quietly using it as a tool. She smiled and said something Daniel never forgot. The wealthy often have entire teams of professionals helping them avoid expensive mistakes. Most ordinary people don't. Daniel thought about that Tuesday morning in Austin a lot after that. About the loan officer who wouldn't even ask him to sit down. He wasn't angry at her anymore. He understood now that the system wasn't designed to judge him personally. It was designed to reduce financial risk, and that often means people with stronger financial histories receive easier access to credit and specialized services long before anyone ever sits across from them again. He thought about the entrepreneurs he'd read about over the years. Sarah Blakely building Spanx with $5,000 and no outside funding, Damon John maxing out credit cards to keep FUBU alive, Howard Schultz getting turned down by bank after bank before Starbucks became what it is today. Many successful founders, including well-known names like Mark Cuban, have spoken publicly about facing early financial rejection before anyone in a suit would return their calls. Nobody hands you trust before the numbers already prove you deserve it. And by the time the numbers prove it, you almost don't need the trust anymore. That's the part that stayed with Daniel the longest. Not the money, not the private banker or the faster approvals. It was the realization that the version of him who needed help the most, sitting in that parking lot with $400 and a cracked laptop, was the version the system trusted the least. And the version of him who barely needed anything anymore was the version it rolled out the red carpet for. Money doesn't change the rules. It changes which rules apply to you. And maybe that's the hardest lesson in business. The people who need opportunity the most are often asked to prove themselves first. The people who need it the least are often the ones it's offered to automatically. That's not a complaint. It's simply how modern finance works. And once you understand that, you stop asking why the game feels unfair. You start learning how the game is actually played. He still keeps that folding table in his office in Austin, not because he needs it, because every time someone new walks in nervous, clutching a business plan, unsure if they belong in the room, he wants them to see it. He wants them to know that the coldest room they'll ever stand in is usually just the first room, and that if they're stubborn enough, the room eventually changes, not because they became someone else, because they refuse to stop showing up as exactly who they already were. Because behind every successful founder, there's always a story most people never hear. And that's exactly why we tell them here on Founder Empire. If this story hits something in you, if you've ever felt small standing in front of a system that hadn't figured out your worth yet, do 3 things for me right now. Subscribe, so you don't miss the next story like this one. Hit like so this reaches someone else who needs to hear it today. And drop a comment telling me the moment you felt invisible before everything changed. Because I read every single one. And your story might be the next one we tell.